Hello, my name is Gerry Vahey and I work for a firm called Mazars. We are a firm of auditors, business and taxation advisors. Most businesses during their life cycle will at some stage consider expanding overseas. There are a number of important commercial considerations that need to be reviewed before you expand overseas, and one of the most important ones are the taxation implications of expansion. Most jurisdictions have similar type rules governing the taxation implications in each jurisdiction, but there are some differences, and it's important to consider these at the outset so as to ensure no problems develop along the line. There are a number of different specific items that need to be considered, and the first one is a taxable presence. For example, there are two situations. You may be trading with a country, and in that instance you don't have a taxable present in that jurisdiction and there's no requirement to register and pay taxes there. However, you may be trading in a country, and if you're trading in a country, then generally there is a requirement to register for local taxes and pay taxes in that jurisdiction. If you have a taxable presence in a jurisdiction, thought needs to be given to the appropriate structure in that jurisdiction. For example, you may be operating through a branch, or if you have a high level of substance in that country, you may set up a separate purpose company and trade through a limited liability company. The second point to note is that you need to be familiar with the tax administration in that jurisdiction. For example, what are the rules governing the frequency of the submission of tax returns? What are the rules governing the payment of taxes, the frequency of the payment of those taxes? What are the rules in relation to, say, for example, if you're seconding employees from your home country to that foreign jurisdiction, is there a requirement to operate local taxes in that jurisdiction? Most businesses, when they're in expansion mode, have a requirement for financing. You need to give careful consideration as to the tax deductibility of finance. For example, if you're borrowing locally, will you get a tax deduction for the interest cost against the profits in that jurisdiction? If borrowing locally is not an option, the parent company may have to borrow in their home country, and consideration needs to be given as to whether or not the home country will give a tax deduction for that interest costs. In addition, there are transfer pricing rules between countries, and it's important to note that these prices between connected parties need to be at market value. You need to bear in mind that an overall objective of this is to minimise the overall group tax rate, while considering that prices charged between one country and another have to be at market value. Most countries have double taxation agreements which provide for the reduction or the elimination of double taxation on the same element of profit. So if you are going into a foreign jurisdiction, you need to examine the double taxation treaty and ensure that the repatriation of, say, for example, dividends is done at a very, very low rate of withholding tax or a zero rate of withholding tax. And finally, when you're starting off, it's always useful to begin with the end in mind. For example, what are your plans 4 or 5 years down the line? Are you going to sell the business? Are you going to keep it? If you're going to sell it, you might want to consider, well, does the foreign jurisdiction provide for an exemption or a reduced rate of tax on the disposal of the business? Those are a couple of key things that what you need to consider if you are expanding overseas, and we in Mazars have a dedicated international tax group that can assist you in this area. Thank you.